All right. Good afternoon, traders and investors. Let me get my screen up here for 1 second and discuss this turbulent day here. We'll have to check what the VIX is doing. S&Ps, hey, we're not losing jobs yet, right? That was a rally, sent us over for Monday's high, Tuesday's high. Gave it all back, maybe because interest rates aren't going to go down. And what do you know? Buy the dippers after we lost 80 handles. They brought us back to unchanged here. So there we are. Still struggling with 7,000. Let me bring in our options expert, CC Lagator. CC, how you doing today?
I'm good. I'm really good. Not to sort of overhype today, just because we're live right now, but it is kind of an interesting day because that initial reaction, sentiment into that number couldn't have been worse, right? Based upon, like what we saw last week with, the private numbers and the jolts and all that kind of stuff. So when that number hit this morning and the immediate reaction was higher, I sort of had the immediate thought that you did. I was immediately checking, the 10-year yield and everything to see how that was reacting. The fact that it sold off immediately, I think, was twofold. One is people are like, wait, so we essentially had no job growth for the last year. Is that a good thing or a bad thing, right? You've got, a new Fed chair coming in a few months. So everybody was sort of running through that thought process today. But again, you also just hit the nail on the head. That 7,000 area is really, really powerful. And you could argue it's gone back till late October that we've been bumping up into this area and the market cannot get past it. And it's been a fascinating sort of, passing the baton over those couple of months. Some sectors have been getting wiped out, obviously lately, like software and anything related to crypto and everything. Meanwhile, gold and silver went nuts. And so that dragged up materials. You had healthcare going up. You had financials doing really well for a while. But what's interesting is it's almost like, we've seen it the past week. You can't really move this market if these mega cap tech companies don't go with it, right? And even on a day like today, Microsoft, I hate to bring this up, Joel.
Yeah, you didn't send me my hedging strategy.
It's coming.
Yeah. Well, can you get it to me before it hits 300?
Yes. So even today, like Microsoft, you're looking at it, it's down, it cannot get off the floor off this 400. We talked about this last week. I sort of bottom picked in two things. One in IGV, which is the software, ETF.
Mm-hmm.
And the other one was an IBIT when that day Bitcoin was just like, it looked like it was going to zero. So the Bitcoin I got out of. IGV I tried to get out of yesterday because I was like, jobs number, I don't know if I trust this bounce. I did not get out of it. And so I'm just sitting there watching that trade today just go lower and lower and lower. So we'll see. I don't know. It certainly doesn't feel like that was the ultimate bounce in much, right? And yet here we are at just shy of all-time highs, and the market's just kind of sitting here.
You feel like crap.
Yeah, you feel like crap because you've been watching so much stuff like in your own portfolio get kind of destroyed, and the market's just kind of hanging in there. And unless you own, the sector du jour of that week, like whether it be energy or whatever, it's really difficult. So what I would say is, we're staring at this slide. So all of these numbers you see today are less than they were when we did the show last week, right? So last week, volatility started bubbling up, the beginning of the week. We started seeing that software thing. Volatility kind of exploded. The VIX only really got to like 23 at its worst moment. Everything is contracted. You've gotten your bounce. This is just below, this is not like bargain basement vol levels what we're looking at, but it's not expensive anymore. Okay. And so if you were Thursday in, before we got that bounce Friday, if you had that feeling and you like, oh my God, I don't know if I can take, we're only 3% off the highs. I don't know if I can take a 5 to 10% move from the highs. You've got a second chance now, right? And these vol levels are not high. These expected moves are not that big, especially, we've got a CPI number coming next week, and we are entering in a very seasonally volatile period right now. So this stretch, February into March, is second only historically, doesn't happen every year, only historically to like September, October.
I knew you were going to say that.
Yes. And so if you look at last year's move, every time I'm on with you, Joel, we're all like bearish. But if you look at last year's swoon into the tariff tantrum, right? Now conditions were different. It was a new administration coming in, everything. So this is sort of not an apples to apples comparison. But if you look, we peaked right around this week, next week on the chart, right? And then we didn't bottom until April. Now that was an extreme case of a 20-some% pullback. But if you just go back on the SPX chart 5 years, you are going to see I think 4 out of 5 times you saw the start of a lot of volatility in the market right around this time period. And it coincides with earnings season, the first of the year, like there's a bunch that happens right now. It's also the end of that sort of opening of the year positioning surge, right? Which we saw, which was sell mega cap tech, rotate into some other stuff. All of that's kind of over. And now you're going to see investor sentiment, what we really think about in these, winter months. And a lot of times it is volatile. So if you want to go to my my live screen, Joel.
Okay.
So go to the Options AI screen. So we talked a little bit about this last week, and I actually put on yesterday, I put on a little bit of a hedge out to March 31st. And I did it in SPY, but we'll look at SPX because the numbers that's what I watch all day. So I know the numbers in my head a little bit more. So SPX down, we talked a little bit about this week. If you are looking on, sort of the big chart and you're looking out, this isn't like I'm predicting the market's going to go down in the next week. I'm saying if you're a little bit worried or if you want to position something to be somewhat outright bearish, there is a convergence right now going on at the end of March. And it is where the 200-day moving average in the SPX coincides with a massive institutional options position that everybody kind of tracks and everybody kind of piles on and copies. And oftentimes when you see periods of volatility, the SPX will go visit those strikes. Now that strike is 64.75 in the SPX, right? And 64.75, I'm about to tell you, is about 6%, 5 to 6% lower than where we are right now, right? So if you were fearing even a 5 to 7% pullback from here over the next month and a half, what I did yesterday was a SPY. Let me just find it. This one. So I did in SPY, the corresponding strikes are about 645, let's say, in the SPY. And you can see the chart looks very similar. So it's down to this level, expiring at the end of March. I paid a little bit more than $5 for this. This is buying the 680 put in SPY and selling the 645 put. And I'm selling the put down at that level. We just indicated that if we do go lower over the next month and a half, it's a spot where I'd probably want to take this trade-off and see what happens in the market next. And arguably, maybe even try to buy the dip there down, 6% or anything. And so this is, this was the trade. We talked about this in theory last week, and I actually did it yesterday. And
that's a 7-to-1 risk reward ratio.
Yeah. So you basically are risking, let's call it 5.5 to potentially make up to 39.5, right? So it is, and if you think about it in another way, it's basically protecting almost 5% of a move lower in the market.
Wait,
And
can
you
it
can
max out at 35? Because it's
max out. So I'm 35. Yeah.
yep,
So
okay.
did I say so 29.5? Yep.
Yep.
So it is, you think of it this way, the way I always kind of pitch a trade like this is you could waste a lot of money hedging your portfolio over time with options, right?
For sure.
However, if you are at all-time highs in the market, you are watching some of the, everybody owns these stocks. We all own, whether you like it or not, you own Microsoft, you own, you have a ton of risk in Nvidia into earnings in a couple of weeks. You own AVGO, whether you like it or not. And if you are getting nervous, and it doesn't have to be SPY, it could be Qs. Qs make a lot of sense, obviously, for where the mega cap risk is in this market. This is the type of trade I like to occasionally put on. And it basically is so that I don't panic sell those stocks, so that I'm not panic selling Microsoft right here.
Correct.
And you know what I mean? And if you do get a move that goes into your trade like this, you now have buying power that you wouldn't have had down there, right? You could sell this if the market came in, if the market tanked 5, 6, 7%, you could take a profit on this put spread. All of a sudden you got some cash and you're like, you know what, I'm not going to say a number in Microsoft, but you're going to buy Nvidia at 150 or something like that, right? And that's what you want, right? You want to be able to buy Nvidia at 150, but it's no fun when Nvidia goes to 950 or 150 and you have no bullets left.
CC question here.
Mm-hmm.
So let's just use let's say you have $100,000 portfolio.
Mm-hmm.
And let's say you got a little fixed income and you got a little bit of cash. So let's say you're 50% stocks. Are you just putting a hedge on that 50% stocks, or are you putting the hedge on the whole $100,000 portfolio?
So what I would say, there's a couple of ways to do this. I tend not to try to hedge the entire portfolio. And that goes back to what we were saying, is you can waste a lot of money doing that, right? So what I want to do is sort of, when I'm comparing, so if you're doing a put spread in SPY or Qs and you did get that move, and you can see, like on Options AI, you could see roughly what that would be worth if you did get that move. And even if it happened like next week, if something came out, you'd be like, all right, this thing is worth, X. I can take it off there. And now all of a sudden I've got this. And so I'm comparing it in sort of dollar to dollar terms. It's not an exact science. I'd like to have a future product where you could, make it an exact science, put in your entire portfolio, see what the, sort of beta of the portfolio would be down 10% in the market. What would I need to do in options to do that? For now, what I do is I'm, using Options AI and using it to see theoretically where these trades would be worth. If I do get that move, how would I feel psychologically at that moment? Would I actually be a buyer? It's hard to say, but at least I'd have that, options trade that if I lost 10 grand or 15 grand in that $100,000 portfolio, would I love to have 7.5 grand of that in profits from an options trade down there? Absolutely. Right. So it would rarely be enough to hedge like every single aspect of the portfolio, but it's sort of like, what would if that did happen, am I really willing to risk $1,000 to potentially have $7.5 or $8,000 in options profit against my $15,000 in equity losses, knowing that eventually those equity losses are going to go away? It might take a year, it might take a month. It depends what, but it will go higher over time. So I want to be using the options part tactically when I'm really worried, because I don't want to have to puke out those longs.
Okay. All right. That's a great explanation for that. All right. So we've covered the let's see, we covered these two. Which one do you want to go to next?
Well, now I'm looking through and putting comments into the chat or anything, any symbols you guys want to go over. One of the things we touched on this last week and we didn't really get to it, but I think maybe today might be a good day because it's, the market's not really doing anything right now. So put up the slide on the stock rescues, and that's the light blue one. Let's just talk over that a little bit, and we can just use
This one?
yes.
Okay.
So I don't think we got very in depth on this last week, and I don't know what's something that everybody in the STN room has been watching closely lately, like Roblox, right? We've been talking about that one for a couple of weeks. It looked like death. It had an earnings bounce, some signs of life. But let's say you're kind of like in the hole on a position like that. What I like to do in options is, so let's say I bought Roblox at 85, and now it's trading below 70. And I'm like, I didn't get my earnings moved to 100. I'm kind of in the hole. I don't know if I want to take the losses here. What can I do in options to sort of, help myself out? Because I'm still, I'm still kind of believe in this thing, but my levels have all changed and I'm in the hole and I don't know what to do. So in something like that, what I would say is you can add leverage to your position via options. And one of the best ways to do that is if you own 100 shares of something, you can do a 1x2 call spread, right? And so basically you are doing a call spread, but at the same strike, you're doing an extra like covered call essentially. And you can do that a lot of times for a credit, especially if it's fairly narrow. So in something like Roblox, you could do like an 80-85 call spread or a 75-80 call spread if your cost basis is up at 85 and you're doing it 1x2. And basically, if you do get your move higher, the options position will take care of your sale and it will improve your cost basis because you're adding leverage through that move. And then you're getting taken out lower than your cost basis, but you're sort of making up the gap. If you have less than 100 shares of a stock, one way to do that is sort of a broken wing butterfly, where it's essentially the same thing. You're doing a butterfly to the upside, buying one call, selling two calls, and then you're just buying a really far other call up, for 10, 15 cents or something like that, so that you don't, you can do that and you would be comparing the dollar possibility of that trade versus where your break even would be in your 50 shares or 30 shares or 20 shares. And so those are two ways that I would say that. The third one is credit put spreads. Now you have to be very careful in this in general, because it's what you don't want to do is sort of add salt to the wound, right? So if you're in a stock and it's going lower and lower and lower, but you still kind of believe in it, but you kind of want to like rescue it, and you can't like average cost in because it's just too painful at this point, you can start to do credit put spreads. And I would recommend that more almost always, but particularly in this case, than like a cash secured put, because a cash secured put is really not giving you much. It's giving you a little premium on top of like you just stepping in and buying more shares. So if you do credit put spreads, you can at least say, like the thing just went down 10%. You do a credit put spread there, all you really need is like a 5% bounce, and you've gotten some back on your shares and you've collected premium from selling below that. And then if the stock keeps tanking, obviously you're adding a little bit of insult to injury, but not that much compared to just buying more stock as it goes down.
Okay. Yeah, you've talked about these strategies before, and after some big corrections and stuff. But it's a way to add to a position, but also what I like about the 1x2 call spread is that it kind of gets you out of it too. You're not.
Exactly. Like you buy a stock for 100, it goes to 60. It's like, man, I would just love a bounce at all. And you can put on a trade where you're like, you get your bounce back to 75, you're out of it, and your cost basis, you've lowered that original cost basis because you added leverage in doing it.
Okay, I think we got all your slides in here, correct?
Yeah, we did.
Okay. All right. So let me pull this down. We got 3 stocks that we're going to go over if we have time here. 152. I'm going to go to my charts. And first one coming in was Chipotle.
Yeah, I just pulled up Chipotle. I'm just looking at this. I know this just had earnings. So it had that earnings. What was the move back in October? Was that earnings? What was that gap lower? October 29th. Yeah, that was earnings, down 18%. Gosh, it was down 13% before that. I mean, these guys are just in general. I mean, they're caught up in the everyone trading down cost things right now.
What a gap fill. Yep. Okay.
I mean, like, you go to Chipotle, you go to Five Guys, and your bill's like $100. It's kind of insane. So what I would say here is I assume this is either this question, and maybe you can put this into the chat. It's either bullish outright. I doubt you're bearish, but it's either bullish outright or kind of a stock rescue situation. Maybe you can throw that in there. Who asked it?
Let me go to the ST.
It was
actually, it came out of the Google chat.
Okay. But anyway,
it was
I would hide
one. What are you looking for on this one? You looking for a rescue trade? You looking for a buyer? What are you looking here? Before you I'll give my quick technical assessment. That was a big old rally, off that $30 up to just shy of 42.
Yeah.
You filled that gap, right? That a lot of people had been waiting for that gap to fill. You've pulled back. For me, if this is like the final turnaround in CMG, then you're not going to get to this 50%. I think if you're buying it here, you hope that it doesn't test that 50%. The best case scenario for me here is just a nice rally. This is your pullback. You get half of it back. You can consolidate and turn higher. That's my technical look. I don't like the burritos, but that's my technical look.
I do like Chipotle. I'm looking. So, I mean, this has already had like sort of a massive bounce. In a weird way, if you are long this,
it's actually they say they shorted at 40.
Oh, all right. Well, what do you need me for? You're already doing well. So, like, did they short stock or did they do it via options? I mean, honestly, you are 100%. Like, you want to know a lot. Here's where I can help on this.
Okay.
So, if you are short the stock or you did it via options, I'm not sure. The expected, I'm sure you're eyeing this sort of, 30, let's say it breaking 35, right? In this gap right here. So what I would say there is there's a couple of things you could be doing. You could be, as it's going lower, you could be selling like credit put spreads and things like that. You could be, as it's going lower, you could start to do, like if you were going to press this thing down to 30 and you wanted to ride it the whole way, as it goes down, you could be doing like little upside call spreads, like $1 wide, so that if like you got totally smoked and squeezed to the upside, you'd be like, all right, well, at least, I had that thing on. But if you wanted to ride this thing all the way down to 30, the expected move for that to happen is basically this summer, I would say. So the expected move right now is out to like July to see this thing at 30. So that's another thing where the options market can help you. It's like, how long would it take for this thing to play out? The options market is saying like, you've got to ride, if you want to ride this thing down to 30, it's going to be out until the summer. And a lot of stuff can happen between now and then. So where options could come in is like, you could, let's just say you got to move down to 35 and you went out to, I don't know, let's go to the end of March. You could be doing like these little, I'm going to make it like these little tiny call spreads, right? Like, so this one's right now it's 30, let's call it 35 cents to make 65 cents. And you could be doing these on the way down, and potentially, that could help if you were worried about getting like squeezed higher. But otherwise, you could also be doing little credit put spreads as you ride down too. I actually prefer the credit put spreads now that I've thought about it. So if you did, let me just get out of this. So, and what I'm talking about is you're selling premium into being correct. So if you think about it, it's like being short stock and doing like covered calls as if you were long stock doing covered calls into your gains. This would be the opposite, and you'd be selling put spreads down below, and I'll show you what we could be getting for some of this stuff. So let's say the 35, 34. If you got a move and this thing started heading to 35, you could be like selling these put spreads to collect 40 cents, risking 60 cents, but you're not really risking 60 cents because you'd be getting gains from your short position. So I actually kind of like this strategy, because you could literally, if Chipotle went sideways for the next month or kind of went down to 37, you'd be adding, 35, 40 cents to your position, which is, pretty significant on looking for a $5 move or a $10 move.
Okay, CC, I said I'd get you off at 158. It's 158. Yes. Good luck at the water polo tournament, and we'll be back with you next Wednesday. So thanks a lot, CC, for Options Unchained.
Excellent.
Yep, I'll catch up with you
soon. All. See you, Joel.
Okay. Real quick, I'm going to pull down. See, we had two stocks that people asked about, and we didn't get to CC's take on it. But I'll just do a couple technicals here for you for Meta. Meta has some news. Einhorn got into this. Was it No, not Einhorn. Ackman got into it. I don't know. I've seen him had some good trades, some bad trades, but this is my setup here. I mean, this is a Meta is just struggling right now. It's a battle between the 50 and the 200 day. But what I would do for just looking long term here for this stock, I think it's pretty easy setup here. This was a big move off the low, right? You've given it half back. Come under it. I think you got, if like this is the turnaround though here at 581, the quad bottom, got a little overextended here, but this is the pullback in the stock, and we're going to go back to 700 or 740. I'd expect a lot of support to develop here in the 660, 664 area. You had the one dip under it, nothing's a perfect science, but it looks like you're getting some concentrated buying here. So that's what I'm looking at longer term. Google's, man, since its report, it's been struggling. I mean, it had that wild bar day on the actual report, but it's 10 points below the 50-day moving average. So that was a big move in it. I think that if I'm using that, I mean, if you want to play from the bull side, I think you got to, for sustained, you got to get over that 50-day at 322. If you've been riding the long up and you just like, you don't know how much pain you could take. If it takes out that earnings low day low at 306.92, I don't think 300 is going to be much of a stop. And there's a lot of room between 300 and 280. It's the first time it's traded above the 50-day for a long time. It's lost the 50-day. Not looking for the 200-day, but that's a technical setup for it in Google. That's it, folks. We are going to wrap things up here. JJ, Teddy, and everybody, thanks for joining us on Options Unchanged. And we should have a fun close with the Brentster and Triple D at 3:30. For people that are new, also remember we have started some night programming with Money Mitch at 7:30, talking swing trading. So maybe if your time zone's a little different, join Mitch at 7:30. Of course, we're always back at 3:30 to 5 with the closing print. Thanks for joining us.